Hello everyone, this is Chris. Welcome back to my channel. So today we're gonna keep working on the financial model we have previously working on for the tax equity. But before we dive into the model, I think some of the background about the tax equity scheme and as well as the flip structure might be helpful for you guys to understand how we structure the model. So some of the background about tax equity scheme. So I have done some research. I figured out that for the U.S. government, for the federal government, the way they improve or promote the renewable energy sector in their country is to, using the CIT deduction. While instead, our country, the way we improve the renewable energy sector is to by paying a subsidy. Basically, in our country, it means that when you generate 1 kilowatt hours electricity from solar or wind, the government in the previous years they're gonna pay you a fee or rate on that. But for U.S. government, you can, if you participate into the renewable energy sector, you can pay less tax. So that's the way they do. So from the overall scheme, they are having two main methodologies. The first one is the investment tax credit, which we termed as ITC. That is equals to 30% of the total capex. And as time goes by, the 30% I think somehow is reducing, but it basically means that if you're having 30 if you got this ITC, you can if you got 30% equivalent total capex payable as the CIT, you can have that deducted. So that is going to be very helpful for for an investor that is having a very heavy CIT payable. And here in US, for example, the Bank of America, JP Morgan, they are having those kind of tax appetite, so they want to participate. So that's the ITC, how it is worked. And the second thing is the MACRS, depreciation. It stands for Modified Accelerated, I think, a certified recovery system depreciation. Basically, it means that you can depreciate a 30 years PP&E within 6 years. It means that with the first 6 years, you're going to have a very heavy P&L losses in the specific in that projects. So if your other business have a very huge amount of taxable income, that can somehow to help you to reduce the CIT payable. So because of the ITC and makers, they're going to be a kind of investor which we named as the tax equity investor. Those kind of investor, they can quickly monetize the CIT payable, immediately. So that is can somehow increasing their return if they participate in the renewable energy sector. Another element or another member will be the sponsor, which is the project developer, which is easy to understand. And so those are two parties. And also there is a very complicated, tax rule or IRS rule. It means that the project's net income and operating cash flow can be distributed disproportionate according to their total investment amount. So what we normally understand is if the sponsor or a tax equity investor invest half and half, they should get half and half cash as well as the P&L income. But in reality, they can define the allocation based on a partnership agreement. So that is how it works. So that can somehow help the tax equity investor to quickly get as much income as possible, and also help the sponsor to get as much cash as possible. So both of the parties can quickly monetize their cash, and that is somehow they increase the return. So that's the disproportionate allocation. And regarding the flip, there are two kinds of flip. When we talk about the flip, it means that the disproportionate allocation changing. In our case, there's going to be a 6 years flip. It means that in the first 6 years, the tax equity investor, they can get 100% net income, as well as it's actually a 2% preferred return, which is normally roughly like 20% total operating cash. That's in the first 6 years. And after that, there's going to be a flip. And the tax equity investor, they are going to get, a changing rate of cash and a changing rate of income. So that is the flip. And regarding the flip, there are going to be two types of flip. One is time-based flip, which I have just mentioned. The second thing is the yield-based flip. For the yield-based flip, it's more like when the tax equity investor, they can get the yield here means the IRR. When tax equity investor get like 8 to 9% IRR, the flip gonna happens, and the cash flow portion and income portion gonna be changing according to their partnership agreement. So that's the background of the tax equity and the flip structure. So I'll pause here, and as you can see from the table, from the graphs here, there's going to be a back leveraging. That's going to be something I'm going to discuss in the later stage. So that will be the discussion for now. Thanks.